Now you can actually use the data mine algorithm to perform a two-way segmentation. Algorithm details are shown down the bottom here. We'll just change that. So algorithm details are shown down the bottom here. Now this algorithm defines segments with respect to maximizing differences across two response variable ratios instead of just one response ratio, as we did in the earlier examples. Like the one-dimensional version, it is maximizing the differences in ratios. Each ratio needs to be a workspace. Now the example that we'll use is to segment across dimensions of loss ratio, i.e. claims cost divided by own premium, and competitive position, defined as competitor premium divided by own premium. Now the way you could intuitively conceptualize this is if you plot each segment on a two-dimensional plane, it's effectively finding those segments that maximize the Cartesian distance between the two resulting subsegments that would also be plotted on that two-dimensional space. So to get to the two-dimensional or two-way segmentation, you just select two-way from the data mine algorithm drop-down. Like before, select the predictors you want to include, like this. Name the data mine run. We'll call it data mine two-way run 1. Pick the two workspaces of interest. Loss ratio is the one workspace, competitive position is the other. Now, since the denominator total sum in this case is 9.6 million, we need to adjust the minimum segment size up from 1000 so as not to generate too many segments. If we set the minimum segment size to be 1000, there will be, and the total premium pool that it's trying to split is 9.6 million, we'll end up with a lot of segments. So let's change this to a minimum of 500,000, and we need to do it separately for each of the two workspaces. It's because in this case the two workspaces happen to have the same denominator, which is own premium, but if the two workspaces could have very different measures, and so we need to be able to manipulate the minimum segment sizes for each of the two workspaces independently, or each of the two ratios independently. Click Run Algorithm. This might take a little bit longer because the algorithm is in fact more complex than the one-way. We can see just down here that the formulas are about 2 or 3 times as long or as complex. Found 7 segments, expected 6. And looks like it's finishing up. Now the definitions page contains a similar table to what we saw before, but it's a bit wider. It contains the same segment definitions here. It contains the variables that make up the definitions. In this case, it only found power and vehicle value to be predictive. It's got the response, or the response sum for that segment, the obs sum for that segment, the ratio, but the train and validation for workspace 1, and it's got exactly the same thing again for workspace 2. Remember, workspace 1 was loss ratio, workspace 2 was competitive position. Up here it's got the same summary statistics. It's got, for loss ratio, it's got the lift, correlation, competitive position, it's got the lift, the correlation. Looks like we could have pushed it quite a bit further in terms of having more segments, given the correlation is so high. Now, we've got a bit more information on the two-way definitions page. We've got the two-way segmentation plot. Now what this does is it's plotted each of these segments on this plot here. The bottom axis here is the loss ratio. The left axis here is the competitive position. So we can see here, for example, segment 7 has a loss ratio of 188% and a competitive position of 149%. And that reconciles to here. This is the loss ratio. This is the competitive position. You can hover over it to get more information. What it does is, where it finds dots in each of the 4 quadrants, a quadrant being defined as being up here if it's it'll be considered to be high low, low low, low high, and high high. It'll colour each bubble one of 4 colours depending on whether it's in quadrant 1, 2, 3 or 4. In this case all the dots just happen to be in this bottom left quadrant and the top right quadrant, so they're only coloured orange and blue. We've got a similar plot down here where the positions of each of the segments are the same as what they are down here, except we've got a head with a stick poking out of it. Now this is useful for validation. Now the head represents the position on this two-dimensional space of the training data that's in this particular segment, and the end of the stick represents the same thing for the validation data. Now a good model with high correlation will have very short sticks coming out of the heads, because the validation data will line up quite closely, or the validation ratio for that segment will line up quite closely with the training ratio for that segment. So this segment didn't fit too well. The training ratio was out here, the validation ratio was over here. For competitive position, it looks like it's not too bad because there's not much of a vertical difference between the head and the tip of the tail, but across loss ratio there's quite a bit of difference. By contrast, some of these other dots have very short or even non-existent tails, suggesting they're quite reliable. Now, two-way segmentations like this are useful where you need to make a trade-off between 2 outcome variables. Maybe, such as in this sort of example, you're conducting a pricing exercise and you want to identify segments that are both highly profitable and uncompetitive so you can reduce the price. Or conversely, you're trying to find segments that are unprofitable and highly competitive so that you can increase the price. Maybe price elasticity rather than competitiveness is a better measure though, because being competitive or uncompetitive is not in itself a reason to change price unless you think that changing price would lead to a change in sales volume, which will come through elasticity more so than competitive position directly, assuming that you've modelled elasticity correct in the first place, which is what the GLM modelling is for. As another example, in the world of finance, maybe you want to segment stocks across their risk and return profile, maybe with risk on the bottom axis here and return on the top axis here. Now, to take this example a bit further, each record in the data set in this case would be a particular stock, and the response variables would be the stock's return and the stock's risk, where each risk might be defined as the volatility of the share price, the volatility of the earning pattern, or the volatility of the dividend pattern. Now, the relevant quadrants might be high return, high risk, high return, low risk, low return, low risk, and low return, high risk. Now, most stocks will fall into either the low return, low risk or high return, high risk quadrants, probably exhibiting a very similar pattern to what we see here, where it increases almost linearly. But any stocks that we happen to find that are in the high return, low risk segment would be worth investigating, possibly for investing in. Now, what traits of a stock might lead to it being found to be high return, low risk. Now maybe it's some complex interrelationship between the stock sector, the dividend yield, recent price movements, recent announcements, or anything else that can be used as a predictor. For instance, maybe a high return, low risk segment definition is stocks in the pharmaceutical sector with high dividend yield, localized operations, and recent announcements about expanding into international markets. Now, such deep interactions can be found with two-way segmentation like this. The most important thing to keep in mind is that in constructing the data set to use in the algorithm, we need to use current or historical information to predict the future or to predict future outcomes, not using future information to predict future outcomes or using past information to predict past outcomes. So what we need to do is pick a date as a line in the sand with all the predictor information on a stock being known at that date, like the stock sector, its historical financials, historical price movements, announcements, etc. And the outcome variables, such as return and risk, need to be based on information or based on stock price performance after that date. Now, return might be, for example, share price appreciation plus dividends in the 6 months following that date, and risk might be share price volatility in the same 6-month period. Now, each record can have a different date drawn in the sand, so you might have different records pertaining to the same stock at different points in time, with predictors representing what's known about that stock at that point in time, and outcomes representing what happened to that stock after that point. So to take this stock modeling approach further, you aren't restricted to just running a two-way segmentation. You could calculate the risk-adjusted return for each record, which is just the return in that 6-month period divided by the share price volatility in that 6-month period, and then fit a GLM to that risk-adjusted return to find what factors drive higher and lower rates of return per unit of risk. That's just one example of how this two-way segmentation, or Predel in general, could be used more generally. Well, thank you for listening to this Predel tutorial series. We hope you find Predel useful and fun to use.